So now guys, we're going to look at what is a shareholder. Remember we spoke about a public company and a private company. Shareholder is basically the owner of the company. This is what a shareholder is. You know, remember when you did in grade 10, we call it a proprietor, and then in grade 11 you call it a partner, but in terms of companies, that is called it's called a shareholder. It's someone that owns the company or owns the shares. And remember, it's not only one person, it could be 5 or 10 people that own that company. Okay, let's then move on. Let's look at these two terms, income tax and provisional tax. What is an income tax? Income tax, it's a charge that you pay for making profit, or you can call it money you pay for making profit. Right? Remember, only for profit. If your company makes a loss, you don't pay income tax. But if you make profit, then there's a charge that they pay you. I think you pay 28% of that profit that you have made. So let's say, for example, you have made a profit of 200,000, right? That's your profit that you have made. So your tax at 28%, it's going to be that 200,000 multiplied by 28%, and then that then gives you I think a number. That's what you're going to pay over to SARS. Remember, you pay this to SARS. So the reason why you get free textbooks and all of these things is because certain individuals and companies, then they pay that SARS, they pay that tax, and then the government use that money to fund the school fees, the road, the clinics, and everything. So then what's then the next thing? And then maybe the other point I want to make with this income tax is that you paid once a year at the end of your financial year. If your financial year is 31st December 2024, then you'll do a calculation, and then you say 200,000 multiplied by that 28%, and then it gives you a number. Maybe for example, let me say, let me use actually an easy example, say 100,000, then that will give me 28, and 28,000 tax. So that 28,000 tax, that's the one that I have to pay over to SARS. And then if you don't pay this, there's consequences, there's interest and penalties that you have to pay. But remember, you pay this at the end of every year, right? So what is a provisional tax? A provisional tax is also the same as tax, but this one you paid twice. You paid twice or 3 times a year, right? So this is what a provisional tax is, but it's better being explained in numbers. So the reason why they created a provisional tax is that they wanted to alleviate companies out of to experience liquidity or cash flow problems, because you might find that at the end of the year you don't have the 28,000 to pay SARS. So what then they did, they said, okay, instead of you paying the 28,000 at the end of the year at one amount, we want you to pay it 1, 2, or 3 times. So which means you take that 28,000, then you divide it by 3, and then you pay it. Maybe you'd pay this in March, and then you pay this in June, and then again, then you'd pay this at the end of the year. So this is what a provisional tax is. So you would estimate how much you think you will pay to SARS, and then you divide it into 3. You paid maybe in March, June, and at the end of the year. But most of the time is they will tell you in the question how you deal with that stuff. Or maybe when we're doing the income tax a module later in the year, maybe in term 2, you will see how we deal with that. Okay, quickly let's move on to dividend. So dividend, so everyone, if you give me 100 rand. If you borrow me 100 rand, you expect something in return. No one just does something for free. So these guys we call the shareholders, guys, because they invest in these companies. They put their own money to start the business. So they also expect something in return. What's that something in return? Is called a dividend. It's like you going to work. If you go and work, you want to be paid. You want to be paid a salary, or you want to be paid a wages for your labor. So the same thing with the shareholders. The shareholders, they want to be paid dividend for their money that they invested in the company. So what is a dividend? You can say, simple words, you can say it's a salary for shareholders, or it's a salary for the owners of the company. But the point to make is that usually, so what would happen, let's go back to our profit, to this 100,000. So you have your 100,000 minus the tax. So what's then the amount that's left there? It's 72,000. That 72,000 that's left, that's the money that's left for the company. Then the board of directors, then they're going to decide whether they want to give this money to the shareholders, or they want to say, okay, maybe we want to grow our business. That, okay, we have one spaza shop in Limpopo, maybe to grow another spaza shop in Polokwane, not in Polokwane, maybe in Gauteng. Then let's take the 72,000 and start the spaza shop. Or you have a choice to take that 72,000 and give it to the people who started the company. You see, so that usually you find that maybe the shareholders would say, oh no, I'm taking the entire thing, then it's going to be my dividend. Or maybe you say you take the 20% of that, that's going to be dividend. And then what's then left, after you take the 72,000 multiplied by that 20%, that becomes a dividend. Then what's left is the retained income that's going to be in your company, and then you use it to grow your business, right? So then now that dividend is two components, the interim dividend and then the final dividend. So this is then the same thing as we've spoken about when we look at the provisional tax, so the dividend that you pay halfway the year, and then the other one that you pay at the end of the year, but they're all dividend. Okay, and then now let's look at what is shares. Remember when we spoke about the difference between public company and then private company. So remember when you did grade 10, you had a sole proprietor and a partnership. So when you, with the sole trader, there is no any share. You don't own any share. But now when it comes to the company, for you to become an owner, you have to own something called shares that makes you part of the business. Example, a company would have 1,000 shares, right? So out of those 1,000 shares, let's say I go and then I say, okay, I want to be part of this company. They'll say they'll give me how many? 200 shares. These 200 shares, then they mean that now I'm part of the company. And then what? So they'll give me 200 shares, that meaning that now I'm the part of the company. What do I give them in return? Then I give them 20 rand. So this is what shares are. And then what is earning? Earning is the same as profit. So it's your profit after tax and dividend. We looked at what shareholders is. I think this is where we're gonna stop for part 1, and then part 2 we're going to start explaining what's a limited liability, what is an ownership, and then what is a control. So that's all from me, guys, and then I'll catch you guys again in part 2, and then follow us on our YouTube channel, subscribe and like our channel. Thank you.